Welcome back to the Deep Dive. This is where we give you that essential intelligence you need, fast and thoroughly. You're tuning in because, well, you want to get a handle on these big shifts in energy, right? And see how leaders are actually responding. So our mission today, we want to connect those huge macro industry trends, the financial pressures, the environmental stuff, with the really practical day-to-day solutions, the ones being implemented right now.
Yeah.
We're looking for that path really to operational excellence when everything keeps changing.
And we've got some great sources lined up for this. We've pulled together strategic insights from a major oil and gas trends report that gives us the market dynamics, the competitive pressures. And we've also looked closely at a leading service provider, EAG Inc. They offer specialized consulting and outsourcing right across the energy value chain.
Yeah, and we're tackling what I think is the absolute core tension in upstream today. How do operators balance that relentless demand for production resilience, strong shareholder returns, with these, demanding new environmental and financial pressures? It's not just about being efficient anymore. You had to be clean, too. And that's where it gets really interesting.
Oh, definitely. The market environment is really setting the stage here. As we look towards the end of 2025, upstream oil and gas, it's facing a tough mix. You've got fluctuating commodity prices, tighter global regulations coming in fast, and frankly, drastically shifting investor priorities. They're looking at sustainability and returns, not just volume. It's a market really at a crossroads.
Okay, let's dig into that financial stress first.
Yeah.
The trend report you mentioned, it clearly shows capital markets are reacting. Upstream M&A slowed down again. Third consecutive quarter, right?
Yeah.
So that's one of the sharpest slowdowns since, the immediate aftermath of 2020.
That's right. And analysts are pointing to basically three main drivers for this slowdown. There are these persistent valuation gaps, first off, then lower commodity prices, making big bets feel, riskier, and also just a fundamental shift in strategic focus. Companies just aren't being rewarded for expansion at all costs anymore.
Okay, right. But capital discipline is the priority now. We keep hearing operators targeting debt reduction, boosting shareholder returns. Doesn't that feel like a massive contradiction? How do you pull back on big buyouts, but still invest the, billions needed for new carbon management tech?
It does seem like a contradiction if you're only thinking about expansion, yeah. But what we're actually seeing is this really ruthless focus on efficiency and organic growth strategies. So instead of buying new production, operators are being forced to squeeze more value, more returns from the assets they already own.
Okay, so optimizing everything.
Exactly. Every single process, from the wellhead right through to the back office. And those large, complex acquisitions, they're being replaced by smaller, sort of more nimble partnerships, maybe targeted asset swaps, things designed purely to boost operational efficiency, keep things flexible.
And we can see that stress rippling out, can't we? Even with high production in Texas, TIPRO, that's the Texas Independent Producers and Royalty Owners Association, TECTIF, they reported upstream employment there actually dipped in September. And crucially, support activities jobs were down month on month. Plus, the rig count was down, about 7.6% year on year.
Yeah, that specific data point really makes the macro financial stress feel tangible. When the big M&A money slows down, when companies enforce strict capital discipline, the immediate hit is felt in the service sector, in the labor markets. It just shows, even while the barrels are still flowing, the underlying economic system is feeling the strain. It's vulnerable.
Okay, so moving from those financial headwinds to the environmental side, segment 2. And there's this, stunning and frankly slightly alarming reversal in the data on methane emissions. Wait, a reversal. I thought things were improving. Global upstream methane emissions actually increased. First time in 5 years. What's driving that? Is it just old infrastructure giving out, or?
Well, the sources suggest it's mostly the sheer scale and the complexity of the operations, that compounded by aging infrastructure. You see, as operators expand production globally, just the difficulty of monitoring, repairing, maintaining containment across thousands of sites, often remote sites, it increases exponentially. It's really an oversight challenge. It highlights that gap between, good intentions and what actually happens on the ground.
All right, the execution gap.
Exactly. And the consequence of this methane spike, it's immediate, it's unavoidable. Methane management just can't be reactive anymore, or voluntary. This basically guarantees tighter regulatory oversight. We're talking mandatory disclosure rules, potential fees, and it's definitely accelerating the deployment of advanced detection tech. Drones, satellites, AI analytics to find leaks, and methane intensity. That's now being baked directly into lending criteria by banks and investors.
Wow. So environmental performance is now directly tied to financial viability. No escaping it. But the concept that really seems to be changing the game here is the rise of carbon intensity, using that as the key competitive benchmark, this idea of carbon differentiated trade. It's reshaping everything, isn't it?
Precisely. This is absolutely no longer just a tick box exercise for the annual ESG report.
Yeah.
It's a hard cost variable. It determines your market access. Producers who can actually prove demonstrably that their product, oil, gas, whatever, has a lower life cycle carbon footprint, they might get preferential access to crucial export markets.
Okay, so how does that work in practice? How does a producer actually price that risk, or maybe that advantage, into their product? If they have lower carbon intensity, how does that translate to, say, better pricing or exclusive market access?
Well, it essentially creates a kind of bifurcated market. Think about regions like the European Union. They have these expanding carbon border adjustment mechanisms, right? So high carbon imports face potentially steep tariffs. A producer with demonstrably low carbon intensity, they could bypass or minimize those tariffs. That makes their product cheaper, more competitive right at the point of entry.
Ah, so you monetize the low carbon advantage.
You essentially monetize it, yes. And lenders, private equity groups, they're embedding these carbon metrics right into their portfolio assessments. Why? Because a high carbon asset is increasingly viewed as a potential stranded asset risk down the line. So success now really requires demonstrating both low cost and low carbon across the whole production cycle.
Okay, that really clarifies the strategic mandate then. If capital's tighter, M&A is slower, and carbon is a direct cost, operators just cannot afford inefficiency anywhere.
Which brings us neatly to segment 3. What does this all mean for day-to-day operations, and how are service providers, like the one you mentioned, EAG Inc., helping tackle these challenges?
Right. We can use EAG as a good example here. Their service portfolio kind of illustrates the three big categories of solutions the industry is chasing right now. Things like advanced process automation, much better data integrity, and specialized tech platforms. And they work across the board, mining, upstream, midstream, even renewables. But the core focus is always on optimization, getting more efficient.
Let's drill into that data piece for a second. Why is data reliability such a huge operational headache right now, to the point where specialized consultants need to step in? Well, honestly, the complexity of modern energy operations has just outpaced human capacity to manage the data effectively. We're talking about, petabytes of raw data generated from drilling telemetry, sensors in the field, production systems, financial systems. It's massive.
Just overwhelming amounts of data.
Totally. And if that data isn't quickly transformed into reliable, standardized, genuinely useful information, you simply cannot optimize production effectively. And you certainly can't meet those strict new reporting requirements for methane or carbon intensity we just talked about. It's that old adage, garbage in, garbage out. Except now, garbage out costs you serious money in regulatory fees and lost investor confidence.
Okay, that makes sense.
So their services, like their consulting services focus on operational excellence. They directly address that need for standardization, for reliable data, and their back office outsourcing. That lets companies tap into experienced subject matter experts for critical functions, helps them meet key deadlines, even if they've had to cut internal staff because of that capital discipline pressure.
And that connects directly to system integration too, right? Which is another critical area for efficiency. You mentioned a specific project success where EAG accelerated a Quorum TPS system implementation for a midstream player. Now, for anyone not familiar, TPS, that's Transportation, Inventory, and Pipeline System. It's specialized software for managing all the complex logistics, the financial tracking of product movement.
Exactly right. And accelerating a system implementation like TPS means the client starts realizing the operational and financial benefits much faster. Things like optimizing pipeline flows, reducing inventory risk, ensuring accurate accounting. They get those benefits months sooner than they would have otherwise. That's immediate, measurable efficiency gain right there.
But the really cutting-edge tech insight seems to come from their specialty platform, New Era Solutions.
Yeah.
You said it's an AI-powered land management platform. This really points to where the industry has to go, doesn't it? For genuine accuracy and cost savings. Why AI for land management specifically? What's the challenge there?
Well, land management is incredibly complex. You're navigating potentially hundreds of thousands of intricate contracts, often decades old, mineral rights mapping, lease obligations, plus staying compliant with constantly shifting state and federal regulations. The sheer volume and, crucially, the unstructured nature of all that documentation, it has just outpaced our human capacity to manage it accurately and cost-effectively using traditional methods.
Too much paper, too many variables.
Pretty much. So AI-powered platforms like New Era can step in and process, analyze, and manage that massive, messy data set almost instantly. They ensure, well, unparalleled accuracy compared to manual methods, and deliver substantial cost savings. It empowers operators to genuinely do more with less. And that really is the definition of operational excellence in this new, much tighter environment.
And the proof is in the execution, as they say.
It seems so. The source material notes EAG completes over 100 engagements a year, and impressively, over 80% of their clients rehire them after that first project. That speaks volumes, I think. It suggests they're delivering tangible, measurable results that translate directly into financial and operational resilience for their clients.
Okay, so let's try and synthesize the key strategic takeaways from all this, especially from that trends report for upstream professionals listening. It seems clear the sector is firmly in a new era. Performance-driven, yes, but also acutely carbon-aware. What are the maybe top 3 non-negotiables now?
Okay, 3 key things. 1, you absolutely must strengthen your emissions detection, reporting, and reduction systems. Urgently. This is not optional anymore. 2, you have to integrate carbon pricing and all these evolving ESG metrics directly into your project economics. They're a hard cost now, not just a nice to have. And 3, you need to build flexible, agile capital strategies, ones that explicitly account for these slower M&A cycles and the shifts in investor sentiment. Organic excellence really is the path forward.
So success isn't just about hitting production targets anymore. It's about demonstrating a proactive, verifiable approach to both environmental and financial resilience. It's a much more holistic view of the business. And you can see that pursuit of knowledge happening across the industry, right? With professionals actively seeking out these tools and insights at upcoming events like the Inertia User Conference in Nashville, the NATO Institute in Boston, and the Nullita Conference down in Miami.
That's right. The learning curve is steep, and people are engaging. Thank you for joining us for this deep dive into those sources today.
And thank you for bringing all that crucial context and analysis. Really helpful.
My pleasure. So a final thought for you, our listener. We all know market volatility is a constant in this industry, but the industry's next phase, it likely won't be defined just by the price of oil. It'll be shaped by how effectively operators adapt to this new reality. The reality we're demonstrating both low cost and low carbon is what determines your long-term advantage. So the question to ponder is, what internal process, what data structure will you focus on optimizing first to prove your operation delivers that kind of resilience?